Good afternoon, everybody. Welcome to our webcast on selecting an option strategy. I'm Connie Hill. I'm happy you've joined me here today as we delve into lots of different option strategies. Now, how many of you were caught off guard with yesterday's news? How many of you are so tired of talk about DeepSeek? Well, that could be some of you, could be maybe everybody in here. All right. Well, today we're going to do something that we can be either avoiding things going on with this DeepSeek situation or embracing it. Okay, we'll get to the details of that in just a minute. I am joined in the chat by Cameron May. I'm happy Cameron's here. He'll help me field some of your questions. I'll keep an eye on the chat, but if there's something a little off topic, something he can help me out with, I'll let him handle it. But otherwise, let us know your questions. We want to know. Now, if you're listening to this on the recording, and I know there are lots of you that do, you're welcome to join us here live. But when you have questions, put them in the comments section in YouTube. I go back and look at those every day, and you can get your question answered pretty quickly here as well. So let's go through our brief disclosures and get busy with our agenda here today. Options carry a high level of risk and are not suitable for all investors. Multi-leg option strategies involve multiple commissions. What we talk about today is intended for information and general information and educational purposes only. Don't consider it a recommendation of any sort. We will be using the Paper Money software application today. That's what we download to our computers. It's the most robust version of Thinkorswim. Investing involves risk, including the loss of principal. Spread trading must be done in a margin account. Past performance of any security or strategy does not guarantee future results or success. Something we want to be aware of on any short options that we have, which in this class we sometimes have those, is that paper money acts a little bit differently than the live market. Paper money will not assign you early. Okay, so that's something you just need to be aware of, because in the live market you definitely could be assigned early. All right, what we like to do in this class is take a look at where our market conditions are, because that can help us decide what strategies we might want to focus on the most. And of course, we're going to look at a lot of examples. We have some follow-up examples that I'm excited to show you about what happened with them. And I'm going to check the chat and see if any of you responded to the idea that maybe you're caught a little off guard with this DeepSeek chat going on yesterday, right? Friday, we were all innocent and didn't know a thing about it. And then come Monday, well, actually over the weekend or Monday morning, when many people became aware of what it even was that was being discussed here. So we'll talk about that. Mighty Mouse says your neck hurts from all this going on. Well, like I said, we're going to find some instances where we maybe embrace a little bit or avoid it altogether with our trade examples. Now, we're going to hop over here to my Thinkorswim platform. Just start out here. Oh, I lost my S on SPX. Here we go with the SPX. Blue line is my 10-day exponential moving average. Red line's a 30-day, a simple moving average. And then down on the bottom, I've got implied volatility. Well, sometimes that really plays into the kind of strategy that we might decide to do here. But as we look at our market conditions here, SPX set a new high on Friday. Of course, we had the big sell-off yesterday. And what did it do today? Man, it's just roaring back. And, this 6,094-ish area could give it a little bit of resistance as it possibly recovers and goes back above it. Okay, so we want to be aware of that. We do see the little bit of a spike here in implied volatility when we had some selling off yesterday. Now, how about the NASDAQ? Our NDX, not quite as strong as the SPX. We saw it break through diagonal resistance earlier, ran up, didn't create a new high. That still is good from last December, but looks like it didn't have much trouble breaking through this diagonal resistance again here today, and it's up above both of those moving averages. Okay, so it looks like, maybe a little bit of a recovery is occurring from what what happened yesterday. And then the Russell 2000, it's been one of the weaker indexes that we've had here. But it did not really take much of a bath here yesterday, right? It had a little bit of pullback action, but it didn't really involve a lot of those small cap stocks. So really the trend is very similar to what it was previous to yesterday. A little bit of recovery here today. All right. Now, Kevin says, DeepSeek caused some of my positions to gap down below the stops. Absolutely, that very well could have happened to many people because those drops were so big on some of those AI stocks, semiconductors, nuclear, power generating that we're thinking we're going to need to power all this AI. A lot of those power companies took a big hit. So yeah, you very well could have been in some trades that did take a hit. Now let's go back here and look at our different strategies. Oh, the VIX. Let's look at the VIX before we. The VIX definitely spiked here yesterday. I'm going to zoom in here. It kind of got kind of close to this 23-ish area when it spiked up here, but then it dropped as the day wore on, right? That volatility seemed to drop. And then, of course, having a bigger drop today. Now, it's not back down to these low levels of 12, 13, 14, but it certainly is moving in a direction where we could say, okay, market isn't nearly as skittish as it was yesterday. All right. So what kind of strategies do you think that might lead us to maybe favor as we come back here to look at that? We've got our bullish strategies on the left. Now, for some stocks, things really haven't changed. There were just certain stocks that got hit yesterday. So some might still be very applicable to working on bullish strategies. Possibly some bearish strategies, although a lot of those that got hit yesterday really have recovered quite well today or are starting to recover. And then, of course, we have some neutral strategies where maybe we're not sure which the direction the market's going to go, that the stock's going to go, that we might employ iron condors, maybe a calendar, maybe a butterfly, double diagonal. We haven't done a ton of these, although I think we might start doing some in future weeks when we start looking at maybe some option strategies over earnings. Okay, so what do you guys think? Well, we're going to hit, actually, we're going to be hitting this column here. We're going to be hitting this neutral column here, not so much in the bearish column. All right. First thing I want to show you is some of our trades and how they did last week. I was a little bit surprised. I was out of commission yesterday, and so knew kind of what the news was. Let me get back here. There we go. I knew kind of what the news was a little bit, but wasn't really in a mode where I could participate in it. All right. We have only got one trade in our option strategies bucket. Usually we like to have a lot of them going on. So let me show you what happened last week. First trade we got into was, this is kind of interesting, Reddit, RDDT. Now, this was a long call vertical. This is what we saw last week. We're seeing the breakout. Market's closed right now, so it filled the next day, which is this day on the 22nd, last Wednesday. And it kind of waffled around here a little bit. And then yesterday, stock actually was down. I've got a gold circle here because it filled our order. Okay. Strangely enough, I want to go show you the numbers here and talk about why that may have been the case. As we come out to our account statement, here's our Reddit order. We got filled on that long call vertical at 230, and we're looking for the stock to go above 190 because that was our short leg. We didn't really see that happen too much, but look what happened. We had set an order out there that said if we get a chunk of it, and a chunk was like 70, 75, 80%, a chunk of it, we said if we can get 422, we'll be happy campers. Well, look where it filled us. It filled us actually at 495. Okay, so we got a real positive fill on something we weren't even expecting to go quite that far. So what do you think happened? If our stock did not go in the direction we expected it to or needed it to above 190, Why did we get filled? Well, sometimes when we have extreme volatility in the markets, what happens with the bid and ask prices? Yeah, they really shoot up and they get really wide sometimes. And so just by having that order out there and knowing volatility went up, well, volatility did help our long call vertical in that situation. Now, it's not very common to have something like this happen, but that's what happened to us. Okay, so we're going to have to take it. All right, next trade up from last week was VST. Now, this was a stock that really got hard yesterday. Okay, this is an energy utility stock. And this is interesting here as well. We did a 185, 187 long call vertical. Again, we got in on this day after seeing what the action looked like on Tuesday, and it got us out here as well. That was actually the day before the big drop. So we actually got filled on that on Friday, which was fortunate and nice, and we're happy about it. Again, we weren't looking for lots of profits in it. We were just kind of looking for a small move. It was only a $2 wide spread. We come back here to our account statement and we pull up our VST here. We can see we did a $2 wide spread. So our max loss or max net debit here would be 95 cents. That's what we had at stake to lose. Again, we put in an order that said, hey, if we get a chunk of it, let's buy it back. And this was I think I misspoke here. It's a $2.50 spread. I said $2, so it's really $2.50. So we were hoping to get filled maybe at 212. Well, we got filled at 260. So we got filled even a tiny bit greater than what the spread is. Again, not very common. And interesting on us, it's look at as we come back here to the chart. Here is where we got in. Here is when we got filled. And we had a little bit of an increase in implied volatility, but not a ton. The huge increase in implied volatility actually came yesterday. So we were just fortunate enough that it moved enough that we got our order filled. Again, both of those are a little bit unusual, so I don't want you to expect that would happen all the time. But in our case, it did. We'll take it. You know, sometimes when the market's spread out, we get implied volatility maybe ramping up a little bit. That can help a long vertical. So just kind of checking here. Let me check what Ricebird has to say here. Oh, we're just having a little discussion, it looks like. Yeah. Said the media has given the DeepSeek more credit than it deserves. Well, we can see this is one stock that really got hit yesterday. If we had not been filled here, yeah, we probably could have been sitting at a max loss here yesterday by the time all was said and done, although we have had till February 7th, so we had a little bit of time for it to recover. Who knows if it really could recover that much, although, you know, a nice little bounce here today was helpful. So kind of interesting on those positions that we have. Now, the last position we have sitting here is KTOS. We're sitting here with a long call. We've got about 24 more days. I want to show you what this looks like. We paid for it. We paid $1.95, and we're down on it a little bit, right? It's down to $1.30 is what it's worth right now. So we're down about 32% is what we're showing on the profit and loss. Now, let's take a look. We've got a sell order out here. And this sell order, oh, it won't show us from there. Let me go to our working orders. Let me show you what it looks like. It looks like we have an order out there to get filled at 35 or 39.50. And I'm going to show you the chart here to keep in mind that's the only exit order we have is to get out at 39.50. As we look at the chart here, we had a nice little flag pattern going on here. So we had the nice flag pattern, or flag pull. Here was the pullback. We saw it here last Tuesday. We were getting in on the breakout. And so we got filled here. And then what did it do? Well, it went down. Now, what are our exit rules on a flag? One of our exit rules are, well, if we hit our target, that's 1 point to get out, and that's the only order we had sitting out there. But if the price dips back down into this flag area, typically we want to be out. It really didn't move that direction to that flag area, but look at, we had some pretty decent pullbacks. If we look at the low here yesterday, that was kind of went over into the low part of the flag pattern. So even though it didn't like come inside of these boundaries, the price definitely did. Now, like I said, I was out of commission yesterday, so not much that could obviously happen with that. But let's fix it today. What we're going to fix it, what are we going to do? We're going to say keep our 39.50 target, but let's do an OCO order. And an OCO on our another stop point, I was looking at doing 32.53. Where is that? This low on this day was 32.58 on yesterday's low, so that's a nickel below it. Okay, today it had a little bit of a move. In fact, if we look at this candle, it almost looks like a doji, where the opening and closing price were very similar, and it ran up and got pushed back down, which really could potentially be a bearish signal for us. Okay, if we're just looking at the candlestick message, yeah, that could be a reversal point for us. So we're going to put on a fairly tight stop. Okay, so again, we'll go a nickel lower than yesterday's low. If somebody wanted to do it based off of today's low, you certainly could. Okay, I'm going to give it just a little bit of wiggle room here. So as we come in here, we're going to actually cancel this order all together, and then we're going to recreate it as an OCO. So come over here, we're going to create a closing order, and we'll just go ahead and pick that. We're going to change our order type to an OCO. All right, exit at a high point, exit at a low point. We'll create two of these orders, so we'll create a duplicate order here, and then both of these are going to be based on the price of the stop. Okay, so we'll make both of them good as market orders. We actually could have done it as one here. I've got it filled out this way. We'll just go ahead with it this way. And then first one, let's put it back in at that target. Okay, so we'll say if the price gets at or above, and so we'll just go with the mark price. We want it to be greater than or equal to, that's our 39.50 price. Get that set in there, and then make sure you've got your greater than and equal, unless I'm going the direction you need it. So we want it to be greater than or equal to. And then on this one, we're going to put it at that nickel below yesterday's low, or we'll get out if the trigger goes lower than, what did I say here? We're going to go with 32.53. And then the idea here would be, if it starts inching back up, great. We're going to take this stop loss, we're going to start inching it up based on the low candle of the day. So we'll see what it does tomorrow. And if it's a big move tomorrow, we might go off of tomorrow's low rather than today's low. Does that make sense? All right, let's hit our save. That's going to be our order. We're going to send that out and let it sit out in our working orders. Maybe we'll be out before we get together next time. We'll see. Two of those trades we did yesterday went really quick. Now, question here is what happened with our serve position? It was a vertical. Serve might not have been in this class. Let me go look real quickly here at some notes. We can go to, that might have been in a different class that we did serve. It wasn't actually in this class. Let's just maybe go over here real quickly. SERV, I don't have anything on that ticker symbol in the last 30 days. So that might not have been my class. Okay, that might have been a different class. Not sure which one it was, but we won't follow up on it. Now, Frankie says, what happened? Was Irene from this class? Yes, IREN. Frankie was from this class. No, it wasn't. This is from our verticals class. We'll talk about it on Thursday. Yeah, we'll talk about that particular trade then. All right. Now, I've got kind of a smorgasbord for us. I've got some trades here. Some people like to trade earnings. Some people don't. Let's start with the people that want to hopefully avoid earnings and who are not interested in any recovery plays from yesterday's sell-off. Okay, we're gonna take the view of that particular person. So first stock we're gonna start with is going to be Shopify. Now, did Shopify have anything to do with what was going on yesterday? No, not one bit. They have nothing to do with AI, although maybe it'll become part of their equation. Who knows? What did it do today? It broke out beyond its diagonal resistance, and it did so on some nice volume. Now, they have earnings coming back, but it's not until the 11th of February. So we have maybe a couple of weeks that maybe we could hit a target before we even get close to earnings. And if implied volatility continues to ramp up here, well, that actually could bode well for a long vertical trade. Now, as we come over here to, let's look at the implied volatility that's being priced in now. We saw on the chart, it was ramping up, but we can see these implied volatility is pretty high. And so what does that typically mean? It means somebody might want to consider selling as part of their strategy, whether it's selling a vertical, selling an iron condor, selling just some sort of premium, even if you're more directional, like doing a long vertical. So this first trade that we're going to do is going to be a long vertical. And we're going to look at the February 14s. Generally on verticals, we'll go maybe 20 to 40 days out as a key area that many traders like to look for. So it's going to be a little bit under that threshold. But I think you're going to find something interesting here, which is that we've got our open interest column, we've got our volume column. There are going to be some strikes that are a little thin that we might want to avoid, and there are some strikes that might have enough activity on them. Now I'm just going to double check this real quick, make sure that's really what I wanted to do. I was looking at doing a long call vertical, and we do have quite a bit of open interest here. We're looking at doing the 116, 118. This we may change here, okay? Because it shifted a little bit from when I first put this trade together a little bit earlier. So we may have to shift something here. We'll take a look. So I was looking at 116, 118, so a $2 wide spread. Yeah, we might be able to keep that. It's $2 wide. It's going to cost us 85 cents. That's going to be our net debit for the opportunity to make what? For the opportunity to make basically $1.15. So we're risking quite a bit less than $1 to make more than $1. Okay. Now we're not going to expect to get crazy returns like we did in our examples earlier. We're not going to expect that. But where is 118? If we need it to go beyond 118, I just want to get my mouse there. Not a big deal. Well, it doesn't look like it's that big of a deal on this stock. Now, it may not have a huge move like it did today. It's not uncommon for stocks to make a really big move and then maybe dink around a little bit, right? Not really move very far, but some nice volume was pushing this. So yeah, it could continue tomorrow. We'll just have to see what it does. Well, if we're willing to risk 85 bucks a trade, our max loss that our max acceptable loss in this class is $1,000. How many contracts can we do there? Somebody had a question on this that wrote into when I say, hey, if you have a question, write it in on YouTube. Let me know what the question is. And then I come back and answer it. So somebody has said, hey, could you maybe do that again? Go through how you actually calculate our position sizing here. So if we're willing to take a loss of $1,000 and we know we could lose $85 per contract, okay, we're just going to divide that 1,000 by $85, not 85 cents. Get that in there. And that's not right. Let's try again. 1,000. Oops. 1,000 divided by $85. Not, I want $8.95. That could have been my problem. All right, we can do 11 contracts. Okay, so we're going to do 11 contracts here. And then we're going to create an order that says if we get a chunk of the gain, get us out. Okay, and so we'll change our single order here to a first trigger sequential. Now, some of you might ask, well, should we put a stop loss on it too? Sometimes people don't want to put on a stop if it's kind of a hedged position, okay? Meaning they have another leg going on here. And so we're just going to position size to our maximum loss. If you didn't want to do that, you certainly, you could adjust that however you might want. So let's create an opposite order here. And if we get a big chunk of $1.15, because that's our max theoretical gain, if we get a big chunk of $1.15, let's say we get 70% of it again. I like to use different values, sometimes 70, sometimes 80, sometimes if I'm real optimistic, 85%, but looking for a chunk here, let's multiply this by 0.7. And that says 80 cents would look to gain 80 cents out of the $1.05 and would be happy camper. So let's add our 80 cents to our 85 cents. Let's see here, if this will work this way. Okay, good. $1.65. We'll be happy to get out at $1.65. No questions asked. Happy campers on our way if it were to do that for us. And who knows, maybe we'll have some more volatility. I don't expect we're going to have a major event like we had Monday, but we could take advantage of it by just having our orders sitting out there ready to execute. And we're going to make that good till canceled. All right, any questions on this? If you do, let me know. We're going to put this down on our option strategies grouping so we can keep track of it there. All right. Okay. The question that was asked here was about what was that serve, and you're wondering what happened with it. And somebody dug up the date on that. He said, no, it really was this class. We did it on the 15th of January. Well, if I put 30 days back in here under my my account statement and said, hey, go back 30 days from now, it should have captured what was in there. I wonder if I was subbing for another class. If I did it in a different class in that coach's account, and that could have been very well the case, then it will be in that coach's paper money account and not mine. And I did a class for Brent Moore's, and so it very well could be in that class that we did it. Okay? Yeah, Cameron's saying, okay, Cameron's tracked that down here as well. So that is the case. That's what happened on that. All right. Next up, let's see what else we've got going on here. Some people like to trade earnings. Some people don't. We're going to do an earnings trade here. We have coming up, actually, I better check this out here, on Starbucks. You know what? I'm off the day. They are probably announcing their news. We can't do this trade. I am off the day. I was thinking it was tomorrow morning that they announced their news, and they don't. So we're not going to do that one. We're going to skip on our could have been earnings trade because we are too late. All right. And next up, let's look at this. I'm going to show you a stock here. Here's a stock. Didn't really have much happen to it yesterday. These guys, if you want to know what they do, over here to the Analyze tab and go to the fundamentals, and you can read up on what these different stocks do. It gives you a little summary here. And they are in the robotics, but they're not really dependent on IA or AI like a lot of other stocks are. Okay, so what happened with it? Well, it kind of peaked up here in December, pulled back, had some real nice support down here about 12.5. What did it do today? I mean, it's up quite high. Secretly, I was hoping it would pull back a little bit more before looking at it today. Right now, I was hoping it would pull back, give us maybe a little bit better entry. But really, if we're looking at this, some might say, well, resistance, short-term resistance, maybe it was something in that area, 14 and some change. Definitely is climbing a little bit higher than that right now. Something like this, let's go to the trade tab. It's a lower price stock. And the strategy we're going to do with this, sometimes people prefer lower price stocks to do it on. We're going to sell a put on this. That means we're very bullish on the stock. Okay, means we wouldn't mind taking ownership in the stock. And if you're not familiar with selling put strategy, earlier today, Cameron, who's doing our chat right now, he did a class on getting started with options on selling puts. It was an excellent class. I don't know if it's posted out there yet, but if you want to get just into the nitty-gritty of that strategy and you're not real well acquainted with it, that would be a good class for you to go to. The idea here would be, one, we collect some premium, or two, we collect some premium and possibly we're put the stock. So we don't want to sell puts on stocks we don't like, stocks that we wouldn't mind owning. Now, as we come over here to the trade tab, I'm looking here to go out to the February 21s. Okay. And it does have some weeklies, but we're going to stick with this one 24 days out. Reason being, I like some of the liquidity out here at these strike prices, more so than the liquidity in the weeklies. Okay, so we want to go where there's a lot of open interest. When I was looking to sell here, let's see if that still makes sense for us to do the 1450. It's gone down a little bit, but that actually still isn't too bad. A 4-cent spread, which is a little wider than it was earlier in the day. It was only by about 2 pennies earlier in the day, which I liked a lot better. 4 cents divided by 46 cents is getting close to 10%. A lot of people will draw a line at 10%. So we're going to hope to get filled maybe at a midpoint price here, okay? Maybe we'll put it in for 44 cents rather than 42 cents, see if we get filled at a little bit nicer area, okay? For our math purposes that we're going to do, we're just going to go with the 42 cents because we might not get filled at 44. We might not get filled at 42 either. Just kind of depends on what the stock is doing tomorrow, okay? Let's go ahead and let's see where 1450 is on the chart. All right, so 1450, oh, my mouse went almost right to it, okay? So right where my mouse is. So does that give the stock a little bit of leeway? Yeah, it really does. From 1519 down to 1450, that's what, about 69 cents? So we would say, yeah, we'd be looking to, I mean, if the stock pulled back some, that's okay. If it went sideways for a while, that's okay. If it kept going up, we'll be happy campers about that. But come options expiration day, if it is below 1450, we should expect to take ownership of the stock unless we close our contract out early. We would have to close it out early before we're actually assigned that position. Okay, if it really dropped, say 1450, and it can even happen at any time. Even if it doesn't mathematically make sense, we have to know theoretically we could be put the stock. It's just not as likely until we get closer to options expiration or we get really deep in the money. So we've got quite a bit of leeway here. Now, suppose the stock were actually put to us, and we'll use the 42 cents here. How much would we be put the stock for? What would our net debit be in that case? Well, our net debit would essentially be the 1450 strike price less the 42 cents. So we'd be looking at kind of a net debit of $14.08. Is that right? Yeah, 8 cents. Okay, that would be a little bit, low, almost a buck lower than where it's trading for right now. Okay, what's our delta here? It's about a 33 delta. I think possibly earlier in the day, I was looking, as I go back and look at this, I was really looking at that 14 because I like that open interest a little bit better. It's not paying quite as well. Here we'll just do one contract because the open interest is not as great as I'd like to see it. But if somebody felt a little bit more comfortable going out and said, oh, I really want to be out here where there's lots of open interest, wouldn't fault that person one bit. That could definitely be a possibility. In which case, if we sold this one, the 14, and the stock were indeed put to us, if the stock dropped below $14, then what would our net debit be at that point? Be $14 minus the 27 cents. Okay. So in a similar range, but different. Okay. So it gives you a little bit more leeway. We'll go ahead. We'll finish what we expected to do here. We're going to sell one contract. If the open interest were more, we'd probably do more, but it's not. And we're going to try to get filled at a little bit better price here. Okay, if it doesn't fill tomorrow, I'll go back, look at it, see what adjustments might need to be made here. And we're going to send that off. We're going to know that what our potential obligation could be to have those shares put to us. So we want to make sure we're really bullish on the strategy. All right. Now, what about you who maybe are looking to buy on a dip? Okay, we had a lot of stocks. One of the areas that really got hit hard yesterday was those that were nuclear energy, right? There's these utility companies that are and nuclear energy today is quite a bit different than it was several years ago, right? A lot safer, a lot cleaner, and so forth. Nuclear energy, some of those stocks got hit, but I want you to notice where this one is sitting. Yeah, it ran up, fell to what? Fell to support, right? And then today closed a little bit above that support area. So some people might be interested in maybe a recovery type play. Now, this looks like it could have earnings on the 12th. Okay, so we have a couple of weeks, and we might just want to be in it for a short period of time before earnings takes place. Okay, that would be the ideal scenario, but sometimes we don't get ideal, do we? Now, as we come over here to our trade tab, we're going to be looking at this one, doing a short put vertical. Premiums are just so incredibly juicy here. They're just so rich. Okay, so we're going to look at doing a short put vertical. Strikes, let's see if these still make sense to do. I was looking out here doing a 28.27. Decent open interest, but look how low that delta is, a 21 delta. Let's see if it's looking as good as it was an hour ago. All right. So let's change our strike price here to 27. Wow, a 35-cent credit on a $1 wide spread with something that has a 21 delta that right now has a probability of expiring out of the money at about 66%. So definitely a high probability trade. Generally, to get in the 60s, we wouldn't necessarily always be that far out of the money. Many times we might just start at a 30-something delta, right? So we really have lots of potential possibilities here. But one thing that I did, and let me just do this real quick, so we'll see if it's similar to what it was showing me earlier. Initially, I was looking at 29.28, okay? And they were giving me the same premium. So I was saying sell vertical here. I was doing different strike prices. And so let's make that our 28. Look how close those premiums are. At some points, as I was sizing them up, there were a few times they were exactly the same. Okay. So my thought was, well, let's go with the one that's a little further out of the money and is still paying a real decent percent here. Okay. We could do the same thing going out a little bit, but in the interest of time, we're just going to go with this particular one. What's our potential return here? We would be having a max theoretical gain of 35 bucks per contract, and 65 would be our maximum theoretical loss. So if we divide our 35 by 0.65, that's given us a whopping 53% return. Okay. That is due to these juicy premiums because implied volatility is so high. All right, we're going to go ahead and we're going to do this one, knowing that our risk on this could be 65 cents a contract, and we're willing to risk $1,000. I'm thinking we could do about 15 contracts. Let's see, $1,000 divided by $65. Oh, that didn't take $1,000 divided by $65 Yeah, we can do 15 contracts here. So we're going to. We'll do 15 contracts, and then we'll do an order to say, hey, if we get a chunk of our 35, let's buy the spread back. Let's close our trade, close down our potential obligation. So here we're going to just say first trigger sequential. We'll create an opposite order. And let's say our chunk on this, since it really is pretty beefy, let's say our 35 cents times, what if we get, say, 75% of it? We would only have 25% left, I should say, not less, left. So we're going to say, let's buy it back at 8 cents. All right, we're going to put our order in, and we're going to expect it to execute. And if it doesn't, well, I'll go back and look at it tomorrow, see what might need to be done in order to get it to fill for us. Okay, we're going to go ahead, we're going to send it in, we're going to put it in our options strategies group. All right, so today we kind of had a little bit of a different strategies depending on what we were seeing. So this trade is looking at a stock that actually is pretty strong. Yeah, it took a dip just right down to the last support level. It's kind of nice to be able to possibly buy in at those points. So we've got that short put vertical trade going on. And I'm going to show you the working orders. Today we also did Shopify. We're looking to do a long call vertical there on something totally not related whatsoever to this DeepSeek situation. And then we also had a short put we're going to sell on Path. Okay, so 3 different strategies, kind of taking advantage of different areas in the market. All right. Normal says, China's also working on fusion energy. You bet they are. You bet. Very good. Any last questions you might have? Now's the time to ask. Let's get our right screen up here. Well, number one, I hope you're getting a feel for some different strategies and what a trader can be thinking about when implied volatility in our scenario is a little bit on the high side right now. Yes, VIX dropped, so the market's not nearly as skittish, but I hope you're kind of getting the idea that, hey, if volatility is low and premiums are kind of not juicy, yeah, let's do some buying strategies. Or if they're seeing a lot of implied volatility, maybe we just stick with some selling strategies. All right. Well, guys, this is our last class of the day. We'll see you first thing in the morning, right at the opening bell. I hope you've taken the opportunity to subscribe to our YouTube channel. When you subscribe to YouTube, it just makes it so much easier for you to be able to find our content. All right, so you come in here, you can see our Trader Talks channel, I should say. You can see what's coming up next, which will be Trader Talks in the morning. And you see some of our recent webcasts. Here's a series right here that James is working on. And so it just helps you find that. I love subscribing for me because I do listen to a lot of different webcasts and podcasts. And it just makes my life a lot easier when I do that. All right. Follow Cameron and I on X if you haven't done so. I'm Connie Hill CS. He's Cameron May CS. Post educational content throughout the day. And if we find some little nuggets, we'll put them out there. And sometimes they can just help you out a little as well. So it's free and easy to do. We'll see you tomorrow morning, first thing. Have a good evening, everyone. Bye-bye.